Good evening, everyone. I am CA Vedant Shukla from Navsari, Gujarat, moderator of this webinar. Before we begin, I would like to acknowledge and thank CA Purushottamlal H. Khandelwal, Chairman of the CPE Committee, and CA Gyan Chandra Misra, Vice Chairman of the CPE Committee, for their leadership and support in making this webinar possible. Their dedication to the continuing professional education of our member is truly commendable. We are delighted to welcome you all in the webinar being organized by Continuing Professional Education Committee of ICI. It is my pleasure to be a moderator for the webinar on GST levy on warranty and related party activities and all about tax on gifts in India. In a short while, we will start this webinar. First, I would like to appraise you about CPE committee. The role of a chartered accountant is evolving continuously to accept newer responsibilities in a dynamic global environment. The future of CA profession depends on being flexible and open to innovation. Therefore, we need of the hour is to innovate as per the requisite of the contemporary business environment and accordingly upgrade the curriculum and education system of chartered accountancy course. The committee also believes that members of ICI should look beyond the traditional area of practice and seek and explore new area of business and professional. And hence, the CPE committee is mentoring the members by providing guidance through various workshops, seminars, national conference, background materials, etc. And simultaneously by encouraging young and dynamic professional to grow as speaker, master of ceremonies, etc. in CPE program. The program for this evening is follows. We have two sessions of 1 hour each and topics are GST levy on warranty and related party activities. Second, all you need to know about tax on gifts in India. Our eminent speaker will talk about our above mentioned two emerging area of professional interest. Today, we have CA Purushottamlal Khandelwal sir, chairman of the CPE committee. Sir, welcome. CA Purushottamlal Khandelwal sir, he is chairman of CPE and convener of RBA, director of ICI. He is having 25 years post qualification experience in the field of audit, direct and indirect tax, and intellectual property rights. This year, he is devoted to fortifying CPE framework and guaranteeing quality across its entire operational spectrum. And this year, major focus would be on upgrading of CPE portal for enhancement of the branding and professional competency of members. Welcome, sir.
Good afternoon, respected faculty for this webinar. CA Nikita ji Agrawal from Aligarh, Vedant Shukla ji, moderator, and from our own state, Gujarat, Navsari, which is the oldest city in Gujarat, Secretary of the CP Committee, Ajit Nath ji Tiwari, co-speaker, Nitish Kumar ji, and respected members. I welcome all of in this webinar organized by CP Committee on every Wednesday. CP Committee is a mother of all the committee. The intention of this committee to upgrade the knowledge of member at large. As you know that we are providing a service stage to the client. If you are providing service stage to the client, you should have a latest knowledge. You have to be updated. Nani Palkiwala rightly said, if client approaches you for any advice, you have to be ready with the latest updation. My committee is dedicated to organize webinar, conference, seminar, half-day seminar, full-day seminar, residential refresher course, learning with fun. So we are doing a lot of works for the members. This year, you have to complete your CP hours in a one calendar year. Previously, there was a 3-year rolling period. Now there is no rolling period. My committee is sending mail every month about the CP requirement you have completed, your pending requirement, But my humble request to all the members, please complete your CPE within a time frame. Because this year, we have come with the consequential effect for non-compliance of CPE. I heard many times in the seminar, member asked them, if we are not complying with CPE hours requirement, what will be the consequential effect? From this year, we have come out with the guidelines to what should be the effect of non-compliant, how they have to comply with the requirement. This year, we have dedicated to the technology. My committee is coming with one dashboard, which having a program of 176 branch, 5 regional council, and 2 center of excellence. Currently, members are not aware that which branch is organizing which seminar. Where is the residential program is going on in the center of excellence. But after one dashboard, you will know every programs which is relevant for your professional interest. It may be income tax, audit, GST, practice, compliances. You have not to scroll the 176 branch website. You can pay from the single window. Another, we are coming with the use of technology for attendance mark of CPE programs. I'm not saying about the biometric attendance. I fully faith on my members. But the sake of conveniency, use of technology, we will send you the link to the registered participant, and you can put a code which will be displayed in the auditoriums. So you will be get the real-time CPE program, CPE update. This year, ICI has done a lot of work. The presidents come out with the AI in ICI, which is very helpful to the member, those who are practicing in the remote area. And you know, the big firms having all tools, audit tools, practice management software. But last year we had given practice software management to all members at free of cost. This year we are giving an audit tool to the all members. We are also providing a beta version of AI, which will be to help put the member and student at large. So we've done a lot of work. I will not make much of time because you all come to here. Nikita ji, faculty is ready. So thank you, Nikita ji, for coming here. I hand over charge to the Vedant Shukla ji. Thank you.
Thank you, sir.
Yes.
Thank you, Chairman, sir, for guidance and information about CP and other information. Today, we have our first speaker, CA Nikita Agrawal ji. She has a vast experience of working extensively in indirect taxation, especially service tax and GST, and has served in GST audit and advisory and its related area for various industry like PSU, power sector, engineering sector, banking, financial institution, etc. She has presented the research paper for FMCG sector and has also been a speaker on the GST related topics. Now I request CA Nikita ma'am to charge of the session.
Thank you. Thank you so much, CP committee, and from the Navsari branch as well. Thank you, ICI CP committee, for giving me opportunity to present my views on the topic related to the GST on the warranty and the related party activities. So, firstly, I'm going to share my video, my presentation, so that the participants and the audiences can able to understand what actually the law is and how my views can be presented on it. So, the firstly, as the topic relates of the two parts, that is on the GST levy on the warranty, and secondly on the related party activities. Firstly, we are going to take on the GST levy on the warranty. So basically, what the warranty is, that is the most important to understand before going through the taxability part, especially on the GST, to analyze the GST and the taxability part on the warranty. So in a contract, a warranty is a stipulation that is part of the contract and the warrantor must strictly comply with it. If the warrantor breaches the warranty, the person taking the benefit of the warranty may be entitled for a remedy for breach of contract. For example, the innocent party may be able to terminate the contract and claim damages, or they may choose to affirm the contract and still claim damages. So it means that if a person is going to enter into a contract, either it is for a supply of goods or for a purchase of a services or as a recipient of the services. So there is a contract has been incurred generally by the manufacturer or the supplier so as to they give the warranty. So if any of the error or any of the disablement has been made to the goods or services by way of warranty, the recipient can avail their additional benefits. So in that warranty, generally the no additional charges is going to be recovered from by the supplier. But there are certain of the scenarios where the warranty is of the limited amount and when additional disbursement has been made, the recovery is to be made from the recipient of the services or the recipient of the goods. So in this way, the GST Council, the many of the representations has been made to the GST Council. So the GST Council, the representation are being made from the various AAR. So in that case, we can say that multiple AARs has been filed at various state of the country to avoid the variation in the views of the authority. The two circulars has been issued by the GST Council. That is a circular number 195 dated 17 July 2023 and second circular number 216 dated 26 June 2024. Especially the Karnataka AAR has ruled out that the manufacturing is not the recipient of the service. Manufacturer is not the recipient of service, but actually the customer is the recipient of service. So the view or the clarity has been given by the GST Council to present how to, in order to tackle such kind of cases and to avoid the litigation. In that case, which the Karnataka AAR authority has said, it means that ultimately the dealer is ultimately the goods or services supplied by the dealer on behalf of the manufacturer, but actually being used or received by the customer. So just to have a clarity on this, so based on these two circulars, I had just summarizes the case by case on each of the cases that the manner of dealing with these activities. So going through the first case is the replacement of the part or the repair service under the warranty without consideration. In the general parlance, in a trade parlance, generally in a warranty, whatever the parts or the repair service or the replacement of the goods, of the complete goods has been made, is being made without consideration. So how the transaction is being going on, it is being like the original manufacturer or we called as an OEM is supplying the goods or services to the customer under a warranty with the original supply of goods and no separate consideration is charged. As there is a no separate condition. So to have a complete understanding of both the circulars, it is important to have this word is a most important, that is a no separate consideration. If there is no separate consideration, then no GST would be levied on such additional replacement or the repair service. However, though the no consideration is made, therefore the no input tax credit is reversal is to be made on the replacement of that part or repair service. So we have to first most important is to understand the background behind such non-reversal and non-payment of GST, because once the goods has been supplied in an original supply, the cost or the cost of that replacement has already been recovered from the supplier, from the recipient or the customer. So in that case, the value has already been in the value of the original supply. So it is not going to be repaid by the customer. So Going forward towards the case number 2 is the replacement of the parts under the warranty without consideration by the distributor on behalf of the manufacturer. Now the case number 2 states that there is a replacement of the parts or the goods under warranty without consideration, just like a similar in a case number 1. But in this case, there is a slight change that the replacement has been made by the distributor on behalf of the manufacturer. So in most of the cases, the manufacturer is not directly doing any replacement or providing any repair service. The distributor or the dealers are there in different cities who are the authorized dealer on behalf of the manufacturer and provides the replacement or the fulfilling all the conditions which is being mentioned in a warranty contract. So there is a 3 cases. In this case too, there are the sub cases. That is, first is what if the distributor is using its own stock or purchasing from the third party in order to replace the part or the goods under warranty. Case number 2 is what if the replacement has been made out of the supply already received from the manufacturer. Case number 3 is what if the distributor has already made the requisition to the manufacturer to replace the goods, and thereafter the distributor is replacing the goods. So there are the 3 different scenarios which is coming up to the GST Council from the trade partners or the different associations or the different authorities in India. Let's have a look and an understanding on each of these cases separately. So taking first one, what if the distributor or the dealer or the authorized dealer is using the own goods or purchasing from the third party in order to fulfilling the warranty conditions? So let's take an example or have a view in our mind, have a picture in our mind ki me as a customer is going to the authorized dealer of a mobile shop. What if the mobile has been break down? I want to replace the certain part of that, or I want to make a certain repair services on that breakdown mobile. What we generally it is mostly being seen ki what actually already the stock of that part, or just to have a prompt service to the customer, but the dealer either purchase from the third party or uses his own stock in order to replace that part to the customer's breakdown mobile. So in that case, what the dealer the dealer would issue a tax invoice to the manufacturer so that the whatever the expense has been incurred out of the pocket of the authorized dealer has been recovered from the manufacturer. Issues the tax invoice treating the service or the part has been delivered to the manufacturer. Charges a consideration from the manufacturer against that replaced part. So in that case, whatever the invoice would be issued to the tax authority, to the manufacturer, GST would be payable by the distributor, and input tax credit is available to the manufacturer as a purchaser. In this case, in the circular, it is being clearly specified that the manufacturer would be treated as a recipient. However, in a Karnataka AAR, the authority has specified that the manufacturer is not the recipient, rather the ultimate buyer or the customer is the recipient. So though the tax, whatever the invoice, whatever the part which has been utilized for the replacement, no input tax credit reversal to be made by the distributor. So in the second scenario, it's the replacement out of the supply already received. So what if, though the dealer is an authorized dealer, he has already received the certain parts in his stock out of the same supplier. So what the authorized dealer would generally do, they utilize that part for the replacement under warranty and issue and request giving the requisition to the manufacturer for the further action. So this circular has specified the transaction like this. So the parts and the goods already received from the manufacturer, which has been utilized for the replacement and the warranty. So though the it is being utilized under the warranty, which is against the already issued tax invoice by the manufacturer then again issue the credit note against the tax invoice for against which the supply has already been made. So the credit note which is being issued by the manufacturer against the part which has been utilized for the replacement and the warranty, that credit note must fulfill the conditions of the section 34 of CGST Act 2017. So section 34 has specifically said that the credit note has to be issued on or before the 30th November of the following financial year to the date of the tax invoice. So in that case, the manufacturer has to see. So the problem would arise when there is a more than 1 year of the warranty is being given for more than 1 year. So in that case, if there is a breakdown in any of the goods, the manufacturer can't issue the credit note because the timeline for issuance of the credit note would get expired. So in that case, the dealer or the distributor would issue a tax invoice to the manufacturer just to have a benefit of this circular and to comply with the GST compliances. So in that case, if the credit note has been issued by the manufacturer against the goods which has already been received by the supplier and utilized under the warranty, the input tax credit has to be reversed by the distributor. Then only the tax reversal benefit has been given to the manufacturer also. In the third scenario, the requisition would be made to the manufacturer to replace the goods. So what is actually happened in a general or trade parlance is when there is a breakdown of any of the goods under the warranty, the customer goes to the distributor or the authorized dealer. Authorized dealer first made a requisition to the manufacturer with the detail of the goods. That particular part is required to replace of the in the goods which is under warranty. Then the parts or the goods for the replacement is being sent to the distributor. And if no additional cost, however, during the replacement, if no additional cost is being borne by the distributor, then no GST would be payable on such requisition. So we have to take an importance that if the distributor taking any additional charges from as a service charges or other labor charges or any other kind of charges either from the manufacturer or from the customer and is a registered GST registered distributor also, then the GST would be payable and there would be no ITC reversal by the manufacturer on the delivery of that part. Further taking towards the case number third, after having an understanding of the dealing with the distributor or the authorized dealer, the case number 3 is related to the repair service. It's not all the time possible that only the replacement of the parts is being made. Sometimes the repair service is also being under the warranty that the distributor or the authorized dealer is required to give to its customer. So when the goods is under the warranty and the repair service is required to be provided by distributor to its ultimate customer and no separate consideration is being charged from the customer, then in that case, there is no additional recovery from the customer, but though the service is being provided to the customer on behalf of the manufacturer, then the distributor is required to issue the tax invoice or the debit note to the manufacturer, considering that the manufacturer is the recipient of service and the distributor is the supplier of the service. In that case, whatever the invoice or the debit note which is being issued by the distributor, GST is payable on it and the ITC is available to the manufacturer. It is just simple in all the three cases that if additional cost or additional services which is not under the warranty and the recovery has been made, then on the GST is payable on it. Moving forward towards the case number 4. So case number 4 is related to the extended warranty. So extended warranty is having of a two types. First, sometimes when we buy a product in a market, and sometimes we purchase the extended warranty at the time of the original supply of the goods from the same supplier. May also happen that we decided that no, we are not going to purchase any extended warranty at this time. Rather, we would purchase the extended warranty after the expiry of the standard warranty. In most of the cases, this manufacturer at their convenience provides the certain kind of standard warranty at the time of purchase only without any additional cost, but in a hidden cost. So in that case, if we are making any purchase of the goods or having an extended warranty at the time of the original supply, so separate consideration is charged because of the additional extended warranty. If the separate consideration is charged and it is a purchase and at the time of original supply, then the composite supply, the concept of composite supply would arise, because the extended warranty is being purchased at the time or along with the original supply. Though the principal supply is the supply of the goods, therefore the extended warranty would be treated as a composite supply of the goods. As whatever the tax rate is leviable on that part, on that goods, the tax rate on the extended warranty, the consideration charge against the extended warranty would be levied. So what if we are not going to purchase the extended warranty at the time of the supply, but even after the expiry of the standard warranty, the separate consideration is charged, and the separate contract would arise from the original supply of the goods. In that case, though it is a separate contract, the concept of composite supply of goods would not arise. In that case, there is a separate contract, there is a separate consideration, there is a separate supply. So in that case, it would be treated as a supply of service. It is immaterial that the extended warranty is for the repair service or of any of the replacement of any goods or the services. Moving forward towards the case number 5. So in a case number 4, we had studied if we take an extended warranty from the same supplier from which we had purchased the goods. But what if it may also be the scenario that we had purchased extended warranty from some other dealer, from some other manufacturer, also for the similar goods, or some other authorized dealer as well. So the scenario can be a different, and which requires a special analysis. In case number 5, the case number 5 is related to the extended warranty by the original equipment manufacturer or the third party other than the supplier of the goods. Again, there would be two types of scenarios are there. What if at the time of original supply, we would take a extended warranty from third party? Sometimes it may happen that the third party or any of the shopkeeper is giving the warranty on their own pocket. So just to have a good marketing or a good reputation into the market. So in that scenario, the case would be the different. So in the first scenario, when there is an original supply, we had taken the extended warranty, that it would not be consideration as a composite supply. The reason being, consideration is separate. Contract is being entered with the third party rather than with the manufacturer or the authorized dealer. So even if we have taken an extended warranty after the expiry of the standard warranty, again there is a separate contract, separate consideration is being charged. So the concept of the composite supply would not arise. So in both the scenarios, though the contract is different, consideration is separate, in both the scenarios, the GST is payable as a supply of services. So these are the 5 cases which clearly explains about the extended warranty or the warranty either at the purchases at the time of the supply or after the expiry of the extended warranty. So we had studied that in the first circular, all these cases, that is a circular number 195, all these cases are being specified. But in circular number 216, the variation has been made that the circular 195 skipped the scenarios where there is a replacement of whole of the goods. Because in that case, the circular 216 has been issued, giving a reference to the circular number 195, and wherever the parts are going to be replaced, it is being also included that when the complete goods is also being replaced along with the parts. So if we had seen when there is a composite supply, if we had taken the warranty from the same supplier against the goods, then it becomes a supply of service. Moving forward towards the second part of my presentation is towards the GST levy on the related party activities. So going forward towards the GST levy analysis, it is most important to have an understanding the concept of the related party. Under section 15, in a GST law, CGST Act, there is a section 15 which specifies the determination of the transaction value. And the explanation to this section clearly specifies the detailed meaning of the person to be a related party. See, if I'm talking about to myself, who would be the related to me under the CGST law is the officer or director of one another business. It means that if I am having a business and there is another business, and in both the business there is a same director, so both the businesses are the related. Next is the partner in a business. It means that if I am having a business and me and my partner both are the related person. The relationship of the employer and the employee is a related person. It doesn't mean that whatever the constitution of the firm is, whether it is a private limited, whether it is a proprietorship, whether it is an LLP or a partnership. Second, next is person directly or indirectly owns, controls, holds 25% of the shares or stock or both. Next, one directly or indirectly controls the others. It means that I am controlling the another's business, having no other relationship of the directors or anything, or some other one is controlling my business. Next, both are directly or indirectly controlled by a third person. If any of the third person is controlling my business or any of other business, then we all three are the related person. Next is together they directly or indirectly control a third person. Next, sole agent or a distributor of the other. If my business is having any distributor or an authorized dealer, we both are the related person, because it impacts the prices or the valuation or the arm length prices between the parties. Member of the same family. So same family means the spouse and the children of the person, and the parents, grandparents, brother and sister. If my brother is having a certain kind of business and I'm also having a business, so whatever the supply we both exchange each other, there are the high chances of the having a adverse impact of the prices. Maybe I'm just supplying the goods or services at a lower value other than the market value, and maybe he is supplying to me other than the market value. In that case, the concept of the related party would arise and the provision related to the related party would apply. Moving forward, as I already told you that the related party, there the value or the transaction value can be adversely impacted between the related parties. So in that case, the rule 28 has been inserted under the rule CGST rules 2017. Clearly specifies that any of the transaction incurred between the related person, the transaction value must be derived as an open market value of the supply of services or goods. However, if the open market value is not able to determine, then the value of the supply of goods or services of the like kind and quality. Third, if the supplier, even if the supplier is not able to determine the value against the open market value or any other value available in the market or of the like kind, then the value which is being given under the rule 30 or the rule 31 in that order has to be determined. So based on the cost of production, we can determine the value as well. However, there is a proviso has been inserted in the rule 28. It clearly specifies that where the goods are intended for the further supply as such by the recipient, the value shall at the option of the supplier be an amount equivalent to 90% of the price charged for the supply of the goods of the like kind and quality to by the recipient to its customer, not related. So whatever the price, if we are giving it to any unrelated person, of that 90% would be treated towards the transaction value, towards the sale to the related person. There is a proviso. Second proviso has been inserted, which is of a very importance. It clearly says if the recipient is eligible for the full input tax credit, then the value declared in the invoice shall be deemed to be the open market value, whether it is of a zero value or whether it is of any of the high amount. It would be treated as an open market value. The concept behind this proviso, insertion of this proviso, is that there is a revenue neutrality. Being payment of the tax and taking an input tax credit doesn't have any impact towards the government treasury. Therefore, this proviso has been inserted. But the importance is that the recipient is eligible for the full input tax credit. It means that if the rule 42 or 43 regarding the proportionate reversal is applicable on the recipient, then the benefit of this sub proviso cannot be available. Moving forward, 3 circulars has been issued by the GST Council considering the representation has been received to them. First circular is circular number 210, which is related to the related person. So clarification on the valuation of the services of import of services by a related person where the recipient is eligible for the full input tax credit. It means that this circular is clearly being going to clarify on how to value the import of service when the import is being made by the Indian related person and that person is eligible to the full input tax credit. Background behind the issuance of this circular is the very famous ruling has been declared by the Honorable Supreme Court in case of a northern operating system. So in that case, what has happened ki the Supreme Court has declared that there is an imposition of the service tax liability on the import of the deputation services by the related person in India. The concept or the leviability or the provisions in a service tax law is slightly different from the GST law. Before issuance of this ruling, already the sub proviso, which we had studied earlier, has also, the second proviso, which we had already is showing here at the down, has already been inserted in the CGST rules. So in that case, giving a reference to this apex court ruling, the circular has been issued. So this circular is also having a linkage towards the serial number 4 of the schedule 1 of the CGST Act, which specifies that if zero consideration is being specified on an import of service by a person from a related person or any other of his establishment outside India in the course or the furtherance of business, then it is also consideration as a supply. Because generally what had happened is if any of the transaction has been incurred between the related person, no consideration is charged. So in that case, in order to cover this, it has been already being inserted in a schedule number 1 and treated as a supply. Therefore, the rule 28 is required. How would we analyze? We are going to analyze this transaction of the important service. Let's have an understanding by a graphical representation. So let's read. If any of the person outside India is supplying the services to a person in India which is related to the person outside India, so it is a completely a picture that the transaction is between the related person. Then it would be an import of service because the service is being received is in India. So it is an import of service and the place of supply is in India. If it is an import of service, then we and the transaction is between the related person, then we have to check out the entry number 4 of Schedule 1. So what are the provisions would be leviable? Though it is an import of service, then it is covered under the notification number 10 by 2017 of IGST Act of IGST rate notification treated the tax would be payable under the RCM. Though it is the tax would be payable under the RCM, then the self-invoicing is required to be made under section 31, subsection 3, clause F. Now, though the transaction is between the related person, so we have to check out the valuation rule 28, which we studied just now. We cannot deny the second proviso to the rule 28, which is giving a benefit of the revenue neutrality concept. Circular number 199 is required to be considered also, where if any of the state of the is giving a services to another, so the determination of the levy of the taxability is to be incurred on all these aspects. We cannot, before having an analysis on the GST leviability of this transaction, which is covered in a circular number 210, the import of service has to be determined. So the definition of the import of service is given under section 2, subsection 11 of IGST Act, which means the supply of services where the supplier is located outside India, recipient is located in India, and the place of service is in India. The most important are these three variants to become an import of service. So let's have an example to have an understanding. XYZ Associates receives the legal consultancy services from its head office located in Malaysia. The head office is rendered such service free of cost to its branch. XYZ Associates, as is in India, receives the services from outside India, though it becomes an import of service because the place of supply can be determined under section 13, subsection 2 of the IGST Act is the location of recipient. So it is an import of service. However, XYZ may not is a company in India, and if the XYZ is eligible for the full input tax credit, then whatever the value is they determine, even if it is a 0 or any other higher value, can be treated as a transaction value. So import of service from the concept of the entry number 4 of the schedule 1 can be analyzed as if the import of service is with consideration and in the course or furtherance of business, then it is a supply. If it is not for furtherance of business, then also it is a supply because it is with consideration. So if it is without consideration, then the schedule 1 has to be taken and from the related person or the distinct person, and if it is made in the course of furtherance of business, then it is a supply, and if it is not made in the course or furtherance of business, it is not a supply. However, the import of service without consideration, service imported from other than related person, then also it is not a supply. So what we had understood from the circular number 210 is that the most important thing is the eligibility of the recipient to avail an full input tax credit. If the recipient is not eligible to avail the full input tax credit, then the transaction value has to be determined as per the rule 28. And if the recipient is eligible for the full input tax credit, then whatever the value he is willing to wish that tax is to be determined accordingly and the tax is to be paid accordingly. Referring to the circular, another circular, that is 213 circular. It specifies the clarification on the taxability of the ESOP, employee stock purchase plan, or the restricted stock units provided by a company to its employees through its overseas holding company. So the related provisions are the section 2, subsection 52, which defines about the goods, which means every kind of movable property other than money and security, but includes actionable claim, growing crops, grass, and things attached to or forming the part of the land, which are agreed to be served before supply or under a contract of supply. The important definition referring to in this circular is a definition of the services under section 2, subsection 102, which means anything other than goods, money or securities, but includes activities relating to the use of money or its conversion by cash or by any other mode from one form, currency or denomination to another form, currency or denomination, or which a separate consideration is charged. For the removal of the doubt, it is hereby clarified that the expression service includes facilitating or arranging the transaction in securities. The most important part which has been derived in this circular from this definition is that it does not include the money and the securities, which is the most important. It means that the money and securities is not covered in the definition of the services as well as in the definition of the goods. And if it the money and the securities is not a service or the goods, then it cannot be treated as a supply also. So referring to another relevant provision is of the entry number 1 of the schedule 3, which specifies the activities which are neither a supply of service nor a supply of activity. So generally the ESOP or employee stock purchase plan is generally provided by the employer to its employees in the course or in the relation to its employment. So let's have an understanding of the transaction in a pictorial form. If there is a foreign company having a subsidiary Indian company is willing to issue a shares as a ESOP or employee stock purchase plan to its employees. So what had actually happened? There is a cost to a foreign company which is now going to incur to by an Indian subsidiary company towards the issuance of such shares. So in that case, whatever the cost which has been incurred towards the reimbursement to the foreign company, whether the taxability would arise on such reimbursement or not. The question arises here. So what the circular has clearly specified is that no GST would be levied on the reimbursement of expenses on cost to cost basis. It means that if the shares has been issued to the employees by the foreign company for rupees 1 lakh and the Indian subsidiary company is going to reimburse only that 1 lakh to its foreign holding company, then the no GST would be levied on the rupees 1 lakh. However, if any additional fees, markup, commission is charged by the foreign company from the Indian subsidiary company, then it would be treated as an import of service and tax would be charged under the RCM for facilitating or arranging this transaction. So therefore, it is clearly being mentioned as there is no GST in a reimbursement of expenses just because it is a reimbursement on account of the issuance of shares. And shares of the securities is neither a goods nor a services. Therefore, no GST would be labeled on such reimbursement. However, if any of the additional charges, any of the management services or the commission or the fees or the markup is being charged by the foreign company just to have an arrangement of facilitation of this transaction towards the employees, then that would be treated as a GST leviable. Coming towards the next circular, that is the circular number 218, It is regarding the loans. So the circular is providing the clarification regarding the taxability of the transaction of providing loans by an overseas affiliate to its Indian affiliate, or by a related person to by a person to a related person. So it is in a general trade parlance that the foreign companies, foreign affiliates, or the foreign companies is providing the loans to its Indian affiliates just to have a smooth functioning of the business in India and to expand the business in India. The Indian company, maybe the subsidiary company, maybe its branch, or maybe it's a permanent establishment. So, what actually the analysis part and the important part to determine the taxability is, if we take another scenario, instead of taking a loan from an overseas affiliate, if the Indian affiliate is taking a loan from a bank or any of the financial institution, then such bank or the financial institution is going to charge the processing or the service fees in order to cover their administrative cost of processing the loan and the application. And if we had already seen there's multiple kind of charges the bank or the financial institution and the NBFC are also taking in order to process the loan, or certain kind of paperwork and the lengthy process is being going on. Even if we are taking the loan from any of the independent lender, they would also carry out multiple kind of assessment or credit assessments of that particular Indian affiliate or the borrower in order to identify and evaluate the risk involved. Therefore, the process is being lengthy. The many of the activities which the bank or the financial institution or an independent lender would require in order to assess the creditability of paying by the Indian affiliate. But such kind of process, such kind of risk assessment is not going to be made by the overseas holding company towards the Indian company, because all the financials and all the credit worthiness of that Indian affiliate is already in hand with the foreign company. Such credit assessment may include the understanding the business of the applicant, financial standing, creditability of the applicant, source of its repayment, etc. Even it also includes the borrower's cash flow forecast, which the Indian affiliate is required to explain to the independent lender, bank, or financial institution, or the NBFC, which is not going to be made towards the overseas affiliate. The change of the processing incurs saves a lot of fees and the time as well. A lot of processing fees, administrative charges, service fees, loan guaranteeing charges, which is GST taxable, is going to be saved when the loan is being taken by the Indian affiliate from the overseas affiliate. And the variation arises. What if whatever the loan which is taken from the bank and the charges recovered is a GST leviable, no such charges is being towards the Indian affiliate, between the Indian affiliate and the overseas affiliate. So would the loan which is given to the Indian affiliate is GST leviable or not? However, we had already been seen that the money, the transaction of money, not the transaction in money, I'm just saying transaction of money between the buyer and the seller, or between the two parties, is neither a goods nor a services. So taking this view forward, what if the consideration, so overseas affiliates is giving a loan to the Indian affiliates and the consideration is only in the form of interest or the discount, then the interest is interest and discount. No GST would arise on it, just because there is an exemption under the notification number 12 by 2017 of the central tax rate. That exemption notification says any service by way of extending deposits, loans, advances, insofar as a consideration is represented by way of interest or discount. So the interest and discount, no GST would be levied. However, if any fees charged in addition to the loans in any of the form, in any of the administrative charges, or in any of the processing fees, platform fees, or any kind of fees, then GST would be leviable. So it is clear cut. If any of the additional consideration is being charged for any additional kind of services, in all the scenarios, the GST would be leviable. No GST would be leviable on the interest or the discount charged. It is just a similar kind ki when the bank, financial institution or NBFC is giving the loan, they are not charging any of the tax GST on interest or discount. Rather, they are only charging on their finance charges or on their platform fees or processing fees. Thank you so much for having an understanding of my deliberation towards the GST leviability. Over to you, sir. Thank you.
Thank you, ma'am. As no question from members, we end the session. Thank you, ma'am, for that comprehensive presentation on GST levy related to warranty and related party activities. The insight you have provided are invaluable, and I am sure our audience has gained a lot from your expertise. Once again, thank you, ma'am. Now we are moving to our next topic. First of all, I am introducing CA Nitish Kumar sir. He has more than 2.5 years of post-qualification expertise and is specialized in areas like audit, financial advisory, taxation, etc. He has provided strategic financial solution to a diverse clientele ranging from small business to large corporation. Now I request sir to charge of the session.
Yeah, thank you, sir.
Okay, sir.
Hello, everyone. This is CA Nitish Kumar, and I'm from Patna. And first of all, I would like to thank the CP committee, especially the chairman, sir, and vice chairman, sir, for providing me this opportunity to deliver on today's topic. And today's our topic would be all you need to know about taxes on gifts in India. Sir, let me know when my screen is visible.
Visible, sir.
Sir, no voice from your end, sir.
Am I audible?
Yes, sir. Now you are audible.
Okay.
Please continue.
Hello.
Yes, sir.
Yeah. While sharing the screen, am I audible?
No, sir.
Let me try once again. Hello.
Yes, sir.
Yeah. Now am I audible?
Yes, sir. You are audible.
Yeah, sorry for the inconvenience. So today's our topic is all you need to know about tax on gifts in India, and let us discuss about it. Today's agenda would be introduction to gift taxation, and we will define gift and its scopes, and we will be discussing about taxability of gifts under Income Tax Act 1961, and we will discuss about exemption on gift tax and various tax implications for donor and donee, and we will also discuss about reporting requirements, and we will see some practical scenarios related to it, and at the end we will conclude it, and before that we will see how to value some non-cash gifts. So first of all, we need to understand why there was a need to introduce a mechanism to tax gifts, because in India we have a very it is in our culture to give something in gift, right from the ancient times. Okay, but after independence, when the system was in process, so government introduced Gift Tax Act in 1958, even before the introduction of Income Tax Act, which was introduced in 1961. So the reason behind it, because people were shifting their black money in the form of gifts. So there was a need to introduce a mechanism, and that's why Gift Tax Act was introduced in April 1958, also known as Gift Tax Act. But later it was abolished in 1998, and the reason for abolishment of that act was that it was not very much beneficial for the revenue of income tax, and people were using various loopholes in it. So if we talk about Gift Tax Act 1951, it was basically about taxability of gifts above a certain threshold, which was about rupees 25,000. And in case of various transactions related to non-cash gifts to various relatives or non-relatives. But later on, it was abolished in 1998. So during the interim period, between 1998 and again it was introduced with the effect of Section 56 in Income Tax Act 1961 in 2004, which was effective from 1st September 2004. So in the meanwhile, what happened? People were doing massive tax evasion and tax planning in the form of gifts. So in 2004, it was included in it, and after a certain threshold, if gift is received from non-relatives, it would be subject to taxation. So in the coming part, we will be discussing about various other things. So now we will define gift. So what is a gift? Everyone wants gift. So it includes any sum of money, movable or immovable property received without consideration. So if we receive something with consideration, it is not a gift. It could be of inadequate consideration, but it is not a gift. So to be something called as gift, it must be without consideration. And there are various types of gifts. It could be in monetary terms, like sometimes we give cash to someone, or we receive cash from someone, or someone transfers it from their bank account or through checks. And gift could be in form of immovable property like land and building or both, and it could be a movable property like jewelry, shares, vehicles, cars, and various other things. And this applies to individuals, HUF, and others. So let's move on to the next part, taxability of gifts under Income Tax Act 1961. So Section 56, subsection 2, clause 10 governs the taxability of gifts. And there are various limits related to cash, related to movable property, related to immovable property, which we would be discussing in details in coming part. So to give a brief introduction, you can assume that if any gift received, especially which exceeds 50,000, then the whole amount will be taxable. And here aggregation is done on whole amount in case of cash. That's why I have taken an example. Suppose there is Mr. A who receives 15,000 cash gifts from 5 different people who are not related to him. So you would say that it is below 50,000, but the ultimate sum exceeds 50,000. So the entire 75,000, like if you receive 15,000 from 5 different people, it would sum to 75,000. And this 75,000 is more than 50,000. So the entire 75,000 would be chargeable in the hands of Mr. A. And there are certain exemptions, like gifts from relative are exempt, but from non-relative are fully taxable. In the later part, we will discuss about the definition of relatives and others in details. And also there are certain exceptions, like gifts received during marriages and under inheritance, under will, or through some charitable trust or some hospital. And there are various lists which are listed in this section. So we will talk about it in detail. So first, let's move on to define, like what are the various nature of assets, and what are the taxable value, and how aggregation is done, and how it is taxable. So in case of money, so any sum of money without consideration, the aggregate value of which exceeds rupees 50,000, then the whole of the aggregate value of that sum will be taxable. Just in the previous slide, we saw a case like you receive 15,000 from 5 different people, which exceeds 50,000. So the entire 75,000 was taxable. But when we talk about movable property, here aggregation is not done. Like you can receive 2 or 3 movable property below 50,000 from 3 different people. So the sum is above 50,000, but that would be not taxable. So here, first we will talk about movable property received without consideration. That is the proper case of gift. So here the aggregate fair market value of that property, if it exceeds 50,000, then the entire amount is taxable. For example, you receive jewelry from your friend, which is beyond 50,000. And as we all know, recently there was marriage of son of Mukesh Ambani, and he gifted a diamond embedded watch to various guests. So we will remember this quote and we will define it later, like whether it would be taxable or not, because it was a hot topic during that time. And let's talk about movable property received with inadequate consideration. So what is inadequate consideration? Suppose the fair market value of jewelry is 1 lakh and you paid 50,000 for it and you got it. Or rather, suppose you pay 40,000 for it. So the difference amount, which is 60,000, and this 60,000 is exceeding 50,000. So the entire 60,000 amount will be taxable in your hand. So that is the case of inadequate consideration, the consideration which is not adequate. Now, if we talk about immovable property, like case of land, building, or land and building both. So here, instead of fair market value, we use stamp duty value, which is adopted by authorities. So in case of immovable property, if the value exceeds 50,000, stamp duty value exceeds 50,000, then the entire stamp duty value of that particular immovable property will be taxable in the hands of recipient, whether it's case of land or building. So stamp duty value in that case is very much important. For example, you receive a flat from your friend whose SDV is 1 crore, and you are saying that no, I haven't give him something, or I have received this in free of cost, but the entire 1 crore will be taxable in your hands under the head income from other sources. Later we will discuss like under which head it is taxable and at what rates these are taxable. At present we are only defining various nature of assets which are considered for gift and what are the taxable value. Now let's talk about inadequate consideration in case of immovable property. So what happens many times, like what was the case, why this inadequate consideration clause was required? So people were doing massive tax planning with it. For example, there is a property of 1 crore and I sold it for 10 lakh, for example. So I would say that, yeah, I have received some consideration, but it is inadequate. So to curb this and to have a control over this tax evasion and various shifting of black money to white money, so government introduced this clause. So even earlier in 2004, only even before that, only money was included. So people were started shifting black money or started shifting their money through properties and various movable or immovable properties. So there was a need to introduce movable property and immovable property in the definition of asset for this section. Okay. Now let's move on to various definitions for this section which governs the taxability. We talked about section 56, subsection 2, clause 10. So here there are three definitions which are very important. Like, what is property? What kind of property are governed under this section? This is of utmost important because for this section there is an exhaustive list of property. Only these property, if received as gift, would be taxable. Apart from these, if you receive any gift from any unrelated person who is not your relative, it would not be taxable. So being a consultant, even various time our clients ask like whether it would be taxable if I get this gift from my friend, whether it would be taxable or not. So these definitions are very important, which you are seeing on your screen. So for the purpose of this section, capital assets of the SSE, which includes like immovable property, whether it is land or building, it comes under purview of this section. So if you receive any land or building from any unrelated person, it would be taxable under this head. And let other parties shares and securities. So whether it is a listed shares or unlisted shares or any kind of securities, it comes under the purview of this section. Now, jewelry and bullion. So bullion means gold and silver in its purest form, and jewelry. So not only jewelry, which generally in India women used to wear in their neck. Not only that, there was a clarification. Basically, there was a case in which SSC did what SSC did. He embedded diamond and other ornaments in his sofa, and he started shifting that. So there was a judgment, and after that judgment, there was a clarification from department that jewelry will include any kind of ornament or gold, silver, or diamond embedded in any wearing apparel or any other movable property. So when I give example about Ambani's son's wedding, so you all must have heard that he gifted diamond embedded watches to all his guests. So in that case, though it is a watch, and watch is not under definition of this property as per this section, but as diamond was embedded in it, it comes under the purview of jewelry. So it would be taxable in the hands of all those celebrities who received gift from Ambani. And apart from jewelry and bullion, there is archaeological collections, like which you must be anyone can have from their ancestral property and from their parents. So that are also taxable if you receive a gift, and if you give those archaeological collections to someone, so it would be chargeable under his hand. And if we talk about drawings, paintings, that is also under this section. So for example, Salman Khan gives his painting, like he's also a painter. So if he gives someone his painting, so to any of his fan, so that would be taxable in the hands of his fan. But if he gives his T-shirt or his branded watch to anyone, that would not be taxable in the hands of recipient because it is not under the definition of this section. And apart from drawings and paintings, there is any work of art and sculptures. And this section also includes virtual digital assets like cryptocurrencies, Dogecoins, Bitcoins. So if you receive any kind of Bitcoin or Dogecoins from any of your friend who is not your relative, so it would be taxable in your hands. So basically, the list of property which we discussed here, it is very exhaustive list, and any asset property apart from this, it is not taxable in the hands of recipient. So that's why I have given one example. So suppose there is Mr. A who gives to Mr. B an agricultural land in rural area whose SDV is 1 crore and gold deposit bond 1999 whose FMV is 2 crore and watch worth rupees 60,000. So though the value of these gifts are more than 50,000, but as these are not under the definition of property, this would not be taxable in the hands of Mr. B. So you can have some tax planning over it being a consultant. We can discuss it separately. And apart from a property, now there are various exemptions on gift tax. Let us discuss about it. So the various list you are seeing here, any amount or any kind of gift or any kind of property or anything received from these, it would not be taxable in the hands of recipient. So if we talk about relatives, we will see the definition of relative in a coming part. So any gift received from relative, it would not be taxable in the hands of recipient. And on occasion of marriage, so any cash gift received on occasion of marriage is not taxable in the hands of recipient. But here one thing is very important which you need to take care, because we are consultant and we need to give advice to our clients. So there should be a limit, like in case of marriage. So how many people can someone invite? 500, 1000? And considering the fact, if you invite 1000 people and everyone gives you 1000 or 10,000, so there is a limit. Like one can't say that I invited 1 lakh people or 20,000 people in the marriage of my son. Or even in that case, suppose you have shown that you have invited more than 5,000 people in your marriage. So there would be question like how you have that much amount of money to invest or to throw that kind of party. So there should be a limit. Like people use this as a tax planning tool, especially in case of marriage, but there must be a proper limit for it. And apart from marriage, if any gift is received under a will or inheritance, suppose a person dies and his son inherit his property, so that inherited property will not be taxable in the hands of son. And suppose someone has written a will that after his death or his property would be in my name. So in that case, if I receive something under a will, that would not be taxable in my hand. And what is in contemplation of death? So suppose there is a person who is ill and who is about to die, and he just said that after his death, his movable property would be gifted to me. So that is the case of contemplation of death. So in that case also, that gift would not be taxable in the hands of recipient. And there are various charitable trusts which are registered under section 12AA, which are mainly for charity purpose. So if someone receive any monetary assistance or any kind of gift from that trust, that would not be taxable in the hand of recipient. And in case of any trust created solely for benefit of relative of individual, in that case also there would not be any taxability of that amount or gift received. And apart from this kind of trust, if you receive any kind of medical assistance or in monetary assistance from a hospital or medical institution, because as these are for betterment of the society, so these are outside the purview of gifts. And any money or assistance, like various money are received from prominent students as a scholarship from various universities or educational institution. So in that case also, that scholarship amount, like in various cases scholarship amount goes up to around 10 lakhs or 20 lakhs. So in that case also, that is not taxable in the hands of recipient, because these are specifically exempted from the purview of gifts. And there are various way of transactions which are not regarded as transfer under section 47, like which are specifically mentioned that these would not be transfer. For example, resultant company receives some capital assets from the demerged company, or an amalgamated company receives some capital assets from amalgamating company, or the shareholders of amalgamated company receive shares after the formation of the resultant company. So that all those transactions are referred in this section. So in all those cases, those will not be covered under this section. And apart from this, any amount received by member of a family of deceased person, for example, if someone die and his legal representative receives some amount from his employer, so in that case also, that money would not be taxable, or any other property or anything received will not be taxable. Apart from this, any amount received from local authority. Local authority means Zilla Parishad or municipal authority. So they also give some kind of assistance to promote education and for various other reason. So any amount received from these local authority will not be taxable. And apart from this, any fund created or a trust or hospital or medical institution which are created under section 10 subsection 23 clause C, so they have different kind of chargeability under their head, and they claim exemption for that also. So any amount or gift received by them, those medical institution and hospital and trust, they will not be taxable as gift under section 56 subsection 2 clause 10 in the hands of those trust or hospital. So these are various exemptions. So irrespective of the amount of the gift received or the SDV or FMV of the gift received, from all these cases which you are seeing on your screen, they are fully exempted from tax. Now let's move on to the definition of relative. This is the most important part, because we have been discussing from past few times that any sum or gift received from relative is exempt from tax. So what is the definition of relative? So Income Tax Act has defined, for the purpose of this section, especially the section 56 subsection 2 clause 10, there is definition of relative. So I have taken example of Virat Kohli, as I'm his fan, and so considering the fact that Virat Kohli is an SSE, so in case of Virat Kohli, as you can see in the flowchart, his mother and father, so any gift received by Virat Kohli from his mother and father would not be taxable in the hands of Virat Kohli, because mother and father comes under the purview of relative. Now, if we talk about brother and spouse and sister and spouse of mother and father of Virat Kohli, that means chacha, chachi, bua and fufa of Virat Kohli. So any amount received or any gift received from brother and his spouse and sister and his spouse of father and mother of Virat Kohli. So even from his mother's side, like mama and mami, mosa and mosi, even from them, any gift received by Virat Kohli will not be taxable under the hands of Virat Kohli. So if we talk about lineal ascendants, so like grandfather, great grandfather, and their spouses from paternal side and maternal side, both comes under the purview of definition of relative for this section. So any kind of gift received from grandfather or great grandfather or grandmother or great grandmother of Virat Kohli, so though those people come under the purview of relative, so that will not be taxable in hands of Virat Kohli. And if we talk about in same generation, so brother and a spouse of Virat Kohli and sister and a spouse of his sister, they also come under the purview of definition of relative. So any gift or any amount received from Bhaiya Bhabhi and Didi Jiaji of Virat Kohli, so that will not be taxable as they come under the definition of relative. So here, if you see closely, here cousins are not included. We call them relatives, but for the purpose of this section, they are not relative for the purpose of this section. So any gift received from cousins, whether they are from father's side or mother's side, they will be chargeable in the hands of SSE, in this case Virat Kohli. And if we talk about Virat Kohli, his wife Anushka Sharma, so Anushka Sharma comes under the definition of relative. So any gift received by Virat Kohli from Anushka Sharma, his wife, would not be taxable in his hands because wife comes under the definition of relative. And if we talk about wife, so sister and brother of wife and their spouses. So in case of Virat Kohli, like in Hindi we call Sala and Sali and their spouses of Virat Kohli. So any amount received from sister or brother of Anushka Sharma, that will also not be chargeable in the hands of Virat Kohli as those come under the definition of relative. And if we talk about mother and father of Anushka Sharma, that means mother-in-law and father-in-law of Virat Kohli. So any gift or any amount received from them would not be taxable in hands of Virat Kohli. And even the lineal ascendants of Anushka Sharma, like grandfather and grandmother or great grandfather or great grandmother of Anushka Sharma, they are also under the purview of relatives. The important thing to notice here is in case of Virat Kohli, his uncle and aunts were included in the definition of relative. But uncle and aunts of Anushka Sharma, like if he receives any gift from uncle of Anushka Sharma, whether his maternal uncle or paternal uncle, it will not be covered in this section because they are outside the purview of definition of relative. That's why I have mentioned it under the circle. And if we talk about lineal descendants, so son and daughter and their spouses, even our granddaughter and grandson, so they will also come under the definition of relative. So any amount or any gift received by them would be covered under the definition of relative and they will not be chargeable in the hands of Virat Kohli. So these are the exhaustive list of relatives which have been defined under the Income Tax Act. And any property which we have discussed earlier, like property means these properties. Any properties, immovable property, share securities, jewelry, bullion, archaeological collections, drawings, paintings, any work of art, sculptures, virtual digital assets received from these relatives would not be taxable in the hands of recipient. But those assets received from any person which are outside the purview of this definition of relative, it would be taxable in the hands of recipient. Whether it's your friend or your cousin or it could be anything. And the reason being, like, why would someone give you a gift? And people used these things to shift their black money and bring into system white money. So in normal parlance, no one gives someone anything without any benefit. Like you can give to your relative, like your father, mother, your daughter, son, brother, sister. But why would you give some unrelated person anything? There is no logic behind it. So that was the reason there is a particular definition and exhaustive list of relatives under this section. So any people outside the purview of this definition, they will be considered taxable for the purpose of this section, like any amount or gift received from those unrelated person. You can call them relative for your personal purpose, but for the purpose of Income Tax Act, all those persons which are outside the purview of this list, they are called unrelated, and any amount of sum and any property which we have already defined received from those will be taxable in the hands of recipient. And if we talk about Hindu undivided family, so any gift or any property received from HUF by those members and from HUF to those members, it will not be taxable. As for HUF and for member, every member is relative. For HUF also, every member is relative. So any gift received from HUF by its members and by members from HUF, it will not be taxable because they are all considered relative for the purpose of this section. So we have defined relatives, and we have discussed various exemptions, like in which cases, irrespective of their amount, gifts are not taxed, and we have defined property. So any property which are outside the purview of this list received from anyone, even from relatives or non-relatives, these are not taxable in the hands of recipient. Only these properties received would be taxable in the hands of recipient. And this is the exhaustive list of relatives. So any amount of property which has been defined received from unrelated person will be taxable in the hands of recipient. Now let's move on to next part. So what are the various tax implications for donor and donee? So donor is the person who is giving the gift, and donee is the person who is receiving the gift. So there is no flat tax rate on gifts received. Gifts are taxed as per slab rates on which the individual falls, like whether in case of new regime above 3 lakhs or old regime below 2.5 lakhs. And as per the slab rate, for example, other incomes are 8 lakhs and gifts received is 3 lakhs. So total income becomes 11 lakhs. So as per calculation by slab rates, it would be taxable in the hands of donor. There is no flat tax rate for gifts. And the donor does not face any tax liability for the gift given. But if donor gives something for inadequate consideration, especially the immovable property, so then capital gain tax could be raised in the hands of donor if we talk about donor. So below is an example. So first consider the fact there is a person Mr. A who is having a land whose cost of acquisition is 12 lakhs, and Mr. A gives this land to Mr. B, and Mr. B is not related to Mr. A. That means Mr. A and Mr. B are not relatives as per the definition of this act. So in this case, there would be no capital gain in hands of Mr. A because under section 47, gift is not regarded as considered as transfer. But in the same case, if Mr. A transfers to Mr. B his land of 1 crore for inadequate consideration, for example 20 lakhs, so in this case the remaining figure 80 lakhs, which is the difference between the SDV of land and the consideration received, this 80 lakh will be chargeable in hands of Mr. A. Here we are talking about the donor. So being a consultant, we should always advise our clients to sell their land or property or anything at SDV because they will be chargeable under the capital gain, and also they will not receive a system in white, like money in white, because they will not receive that amount under the Income Tax Act. So though he can receive 80 lakhs in cash, which is illegal, but to maintain the legality, we should always advise our clients to sell their property at stamp duty value. So, considering the case of gift, if Mr. A gifts Mr. B land whose SDV is 1 crore, so this 1 crore will be chargeable in the hands of Mr. B under income from other sources. And cost of acquisition for Mr. B, if he transfers this property in later years or in coming time, so cost of acquisition in the hands of Mr. B will also be 1 crore. And the reason being that he has already been charged for that gift under the head income from other sources in the relevant year in which he had received the gift. So that's why in future, if he transfers that property as capital asset, so for the purpose of capital gain, in the hands of Mr. B, cost of acquisition would be 1 crore. That is the amount for which he was charged during the relevant year in which he had received the gift. And the period of holding will also be calculated from the date of gift. Like in capital gain, we know the period of holding from is calculated from a previous owner also. But in this particular case, we can assume that only holding period is calculated from the date of gift. And apart from this, if the gift involves property, the like we discussed, the cost of acquisition for the donee is considered as the value at which it was taxable. So apart from this, there could be other tax implication if we don't report these gifts received in our ITR, or there could be notice under section 68 for unexplained credits. Like if you receive 10 lakhs from your brother, so though he is relative, but in your account statement it's not mentioned that you received a gift from your relative. So income tax department can issue notice like explain this credit, and if you are not able to explain, then it could be case of underreporting and misreporting, and your case could fall under base judgment case also. So let's move further. What are the various reporting requirements? So why reporting is requirement? Like you could say that, yeah, I have received gift from my relative. So what is the need to report it in ITR? This is the main part, because many times our client also give this kind of we have discussion from client also. Yeah, I have received a property from my brother. He is my relative. So why there is need to report it in income tax return? But consider the fact like how the department will know that you have received certain amount or certain property from your relative, or whether it is taxable or not taxable. So for that purpose, reporting part is very important in case of gifts. Like we report various other incomes, like if you receive salary, it gets reflected in your 26s, and it is also reflected in your AIS. So this is very important to disclose gifts to eradicate future tax complicancies and various notices from department, and to make things smooth, it is very important to disclose these things. And apart from this, various entities and various institutes like banks and registrars, they have compulsion after a certain limit, like in case of deposits in banks in savings account above 10 lakhs, those are reported. And in case you purchase mutual fund or shares more than 10 lakhs, they are reported. And in case you even you get some property as gift, and the stamp duty value of that property is more than 30 lakhs, in that case registrar are liable to report that to income tax department, and those are reflected in your AIS also. So consider the fact you receive gift from your father of a flat whose which like stamp duty value is 1 crore, and it has been reported by registrar through AIR, and it is being reflected in your AIS. These days everything is reflected in AIS. Even if it's not get reflected, it is your duty to report it. Even if you receive cash from your relative, like you receive 20 lakhs from your brother, so the bank will definitely report it and it will come under your AIS. So after the reply, when the department gives you notice, so you can give reply that I have received so and so amount from my brother. So why would we want that our client should face some that kind of hardship? So being a consultant, being a tax practitioner, it is our duty to educate our clients also the reporting requirements, even in case of gifts. So suppose if someone receives 20 lakhs from a father through account only, and various other credits in that account are his business income. So that 20 lakhs needs to be reported and proper documentation should also be maintained. So why documentation is important? Because we need to prove in later part. Because these days income tax department don't spare anyone. Even whoever, because everything is faceless and there is gone are those days like when you go to department and settle the cases. So these days everything is faceless and you need to give response over the portal. So everything is under surveillance. So you cannot escape anything. If you get transactions like if you get cash gifts or if you receive amount through account, that is also reported. If you receive any property, that is also reported. So it's better to disclose it in income tax return only to avoid future tax complications and various consequences, to avoid those consequences. And if you fail to report those and even in case of taxable gifts, like till now we were discussing about exempted gifts, but in case of taxable gifts, that are also needs to be disclosed. For example, if you receive jewelry from your friend, so friend is outside the purview of relative and jewelry comes under the definition of property. So in that case, jewelry received from friend would be taxable in your hand. Now, that fair market value of jewelry, suppose it's 10 lakhs. So that's 10 lakhs is your income from other sources. It is chargeable under the income from other sources under that head. So you need to mention that amount, that figure, and in other income section, you need to mention that amount, and that would be chargeable as per your slab rates. So if you fail to report those taxable gifts, that is definitely the case of misreporting of income or underreporting of income, on which penalty is around 50% for underreporting and 100% for misreporting. So to save ourselves and our clients from those genuine consequences, these taxable gifts and also non-taxable gifts, even from relatives, are very much important to be disclosed in the income tax return. Now, let's see where to declare gift income in ITR. So, in ITR 1, which is mainly for salaried individuals with income up to 50 lakhs and one house property and various other sources of income from interest, etc. ITR 1 does not have any specific section for exempt income. So if you have any exempt income, you cannot, like in case of gift, you cannot disclose it in ITR 1. So for those individuals who have exempt income in form of gift, whether it's money, property, anything, you cannot file ITR 1. And in case of ITR 2, ITR 3, and ITR 4, so these ITR forms have specific sections to disclose exempt income, which certainly makes convenient for individuals to disclose their gift income. So if you are filing ITR 2, so there are various schedules. Even if you file the online form, there are various schedules for incomes also. So there is a schedule EI, which denotes exempt income. So you need to go to that exempt income section and we need to disclose the income accordingly. So if we move to ITR 2, I have taken here example of ITR 2. So you can see here, first we go to dashboard and we select the respective ITR 2 form, and under schedules, we have schedule EI. Under schedule EI, which is for other exempt income, including exempt income of minor child. So here we need to specifically mention, suppose there is a case you receive 2 lakh from your father. Though father is a relative and this 2 lakh is exempt in your hand, but it needs to be mentioned. So here in the nature of income, it is any other, and in description, you need to specifically mention that this gift is received from father and amount is 2 lakh. So through this, we can disclose our exempt income also in our ITR. So to summarize this part, again, ITR 1 is not for declaring exempt income. We need to file ITR 2, ITR 3 or ITR 4 as per eligibility. But for declaring exempt income, we can only file ITR 2, 3 and 4. ITR 1 is not the correct form to disclose exempt income. Now, what are various other reporting requirements? Suppose you have received a gift from your father. It could be a certain amount of money or it could be a flat. So, for proper documentation and to have some proof, there should be a gift deed. So, why gift deed is important? In future, like suppose you have received 10 lakhs from your father, and even if you have declared it in your ITR, there are chances that department can ask for proof. And even if you receive certain flat or other property or shares, it could be anything, like any property which come under the definition of property. So there must be a gift deed which will basically substantiate the receipt of gift. So gift deed should also be very informative. There must be details of donor and donee, and what is the relation of donor and donee, and there must be clause that it has been given and received in consideration of natural love and affection, and the consideration should also be mentioned. Like I have taken an example of a sample gift aid. So here you can see it has been written that in consideration of natural love and affection, being daughter of donor, the donor hereby assigns unto the donee sum of rupees 10 lakhs. So in this case, the donor is giving donee who is like a daughter and father. So they are relatives, and this receipt of 10 lakhs is specifically mentioned. So this 10 lakhs should be declared in the ITR under exempt income clause, and this 10 lakh would be mentioned in the gift deed also, that this is the consideration. And also it should be mentioned that it is a voluntary transfer. There is no undue pressure or anything, and the person who is donating and giving the gift is having the ownership of the property. Like in case if you are receiving a flat from your father, so there must be a clause that the flat is at present owned by the person, like you, in this case your father. So the ownership details should also be mentioned. The details of property should also be mentioned, like where the property is situated and what are the rights of donee. And after all these clauses, there must be acceptance by the donee that I am receiving this such and such gift and such amount from my father, and there must be witnesses, and there should be clause for revocation also. So we have discussed about various reporting requirements. So we have talked about documentation, we have talked about declaration in ITR, and how it could result in various penalties and interest on tax due. and how your various receipts are reported by various entities like banks and registrars, etc. So now let us discuss some practical scenarios related to gifts. So in case if SSC is not satisfied with the SDV, then his case may be referred to valuation officer. This is the same case which we have read in a capital gain. For example, you received a gift from your friend of a flat of SDV stamp duty value 1 crore. So in this case, it would be taxable as your friend is not a relative and flat comes under the definition of property. And you are thinking that the SDV which is being charged in your hand, it is above market value. So in that case, you can raise a request to assessing officer and your case will be referred to valuation officer. And if the value assessed by and determined by valuation officer is below the previous stamp duty value, then that decreased amount will be, suppose the previous stamp duty value was 1 crore and the after the valuation by valuation officer it comes to 80 lakhs. So in that case 80 lakhs would be chargeable in your hand. And also section 56 subsection 2 clause 10 is applicable even gift made outside India by resident person to non-resident. So under section 9, even if you give some gift to a non-resident who is outside India, who is non-resident as per definition of income tax, under that particular section. So in that case, also in the hand of recipient, that gift or money would be deemed to be accrue or arise in India, and it would be taxable in his hands. And another practical case, that is section 56 subsection 2 clause 10 is applicable only if property is in the nature of capital asset for the recipient. If it is stock in trade, then section 56 subsection 2 clause 10 is not applicable. This is by a CBDT circular. So suppose a case like your mother went to a jeweler shop and she sold her jewelry to that jeweler, and the fair market value of that jewelry is 10 lakhs, and that jeweler gave only 5 lakhs. So you can say that recipient has received that for inadequate consideration. But as this jewelry received by jeweler is not in the nature of capital asset, because jewelry is business asset for that jeweler, for that shopkeeper. So in that case, it will not be chargeable under this section. Though it will be chargeable under PGBP head and FME will be calculated, but section 56 subsection 2 clause 10 will not be attracted. And apart from this, we have discussed section 49 subsection 4, that is, if any person receives an asset as gift or acquire it for inadequate consideration, then the value which is assessed under section 56 subsection 2 clause 10, like the example which we did, so in that case the cost of acquisition of such assets shall be fair market value or stamp duty value which was considered under income from other sources under 56 subsection 2 clause 10, and the period of holding will also be calculated from the date of receipt of gift. So now how to value non-cash gift? So in case of gold, jewelry or other things, we can use the purchase value as on the invoice to be considered as its fair market value, and in case there is no evidence, in that case open market value must be estimated from a local registered value. And in case of immovable property, for example, if you receive any flat or any building, in that case stamp duty value of that flat or that particular immovable property will be considered as your income. And in case of shares and other soft instruments, we can take open stock exchange rates as on the gift rate. For example, if you receive shares from your friend yesterday, so what was the open exchange rate yesterday, that would be considered as the amount of gift received in your hand and it will be taxable. in your hand. So we have discussed various aspects, and to conclude the whole discussion, we can say that taxation of gifts is a crucial aspect, even for personal and for business tax planning also. And we have discussed about why documentation is important and why reporting is essential, and how we can keep ourselves updated on various legal changes, and we should study various case laws for effective tax compliances. So that's all for today, and thank you so much for patiently hearing this. Thank you so much. Over to you, sir.
Thank you, sir. Now, sir, we will take a question answer session. One question from Meena Veravar. Gift deed should be in stamp paper or simple document?
Yeah, it should be definitely, it should be in stamp paper. It could not be in a simple paper, so it must be under stamp paper. Should be notarized by notary public.
Another question from Thane Sandeep Mehta. What will be the cost of acquisition of land for Donny in case of gift received from parents?
So if we receive it from parents, so parents are under the definition of relative. So that is not the case of gift, and it will not be covered under section 49 clause 4, which we discussed. So it will come under purview of section 49 subsection 1. In that case, period of holding of previous owner, like in that question, father, that will also be considered.
Another question from Chirag Jain Thane. A mother wants to gift a property to his son, but the
Mhm.
mother has taken section 54 exemption and is breaching the holding period condition by gifting the newly purchased property within 3 years. Will the exemption will be reversed?
Yes, in that case, exemption will be reversed, definitely.
Last question from Mumbai Mayur Iyer. Can the gift amount of X received from father to
Mhm.
shown to son be
Mhm.
shown in the exempted category of ITR return mentioning the name of relationship and PAN number of the father?
Yes, yeah, that's what we have discussed. I have shown the example also. Like in the exempt income category, we can declare the income, and we can show that gift received from father, and we can also mention the PAN of father.
Okay. No more question from now. I am giving vote of thanks to sir.
Thank you.
Thank you, sir, for demystifying for the complex topic of taxation on gifts in India. Your clear explanation and practical examples have made this subject much easier to understand. As we conclude today's webinar, I want to extend my deepest gratitude to both of our esteemed speakers, CA Nikita Agrawal and CA Nitish Kumar, for sharing their expertise with us. I would also like to thank all the participants for their active engagement. Please keep an eye out for upcoming webinar from the ICICP committee, where we will continue to bring you the most relevant and current discussion in the field of taxation and beyond. Thank you all for joining us today. Stay safe and have a grateful day ahead. Thank you.